Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Thursday, March 14th, 2024 edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for another market open. I don't even know if I can believe my eyes this morning. I tell you, this bull market is so resilient. I'm looking at the headline number on the PPI, which was supposed to come in 0.3% higher, and it came in 0.6% higher, doubling expectations. And if we strip out food and energy and get the core PPI, that came in at 0.3%, which again was about 50% higher than the 0.2% that was expected. And the futures, they're green. They were up a little bit going into the report. The report came out. I know the IWM went a little bit negative pre-market. The QQQ got very close to flat. And I thought, okay, this is going to be it. Here we go to the downside. Next thing, I turn around 5 minutes later, and the QQQ was up over $1. I'm speechless this morning. I don't know. Like I said, betting against a secular bull market is just torture. Market seems to ignore everything, including this report. Now, maybe things changed later. And when I looked just a couple minutes ago, I did see futures had kind of come back down because QQQ, which had gone up, I believe, over $1.50, $1.60 is now up $1. But still, that's up almost 0.25% on the heels of a second straight day of inflation reports coming in hotter than expected. I would not have expected that, but it is what it is. So we just have to deal with it and move on. The 10-year Treasury yield is reacting probably as I would have expected. The yield's moving up, so folks are moving out of bonds. Why? Because you don't really want to own bonds if there's any inflationary concern. So last few days, we've seen that 10-year Treasury yield go from about 405 or 407 back up above 420. So the bond market is reacting the way I would have expected with higher inflation numbers. But the stock market says we don't care. We don't care. And so we're just dealing with that right now. I mean, and it's in the face of options expiring. And there are as many in-the-money call options out there right now. The net in-the-money call premium is as high as I've ever seen it. I mean, if there's been a higher month, it hasn't been by much. And what that tells me is that directionally, that clue is that the market in the near term is probably going to head lower. Market doesn't care. We've seen rotation away from technology over the last month into the more defensive and value-oriented areas, suggesting maybe the market was going to take a pause and that we'd see some selling. Hasn't happened. I mean, I don't know what to tell you, but other than we're in a secular bull market, and this honestly is what secular bull markets do. They just ignore everything. They're resilient. They put their head down. They just keep chugging higher. Now, we haven't broken out on the NASDAQ. That would be something I think the bears would really need to be concerned about because that's the area that's been driving the market. We've seen the S&P 500 move to all-time highs again this week. The Russell 2000 mid-caps continue to look strong. The one area that maybe the one little thing that the bears can hold on to right now is that we saw some selling in the semiconductors. I think that was last Friday, pretty big day. It was a bearish engulfing candle in many of those names. And then we just came rushing right back. So anyway, that's what we're looking at this morning. I can't make this stuff up. The market just doesn't want to quit, at least not yet. But let's take a look at what happened yesterday. So let me bring up the charts for you. There you go. We had the Dow Jones Industrial Average up 38 points. That was about 0.1%. S&P 500 down 10 points, which was down about 0.2%. The NASDAQ 100 down 150 points, down a little bit more than 0.8%. Mid caps up 1/3%. And then we had the IWM small caps up about 0.4%. Transports down 0.4%. So pick one. I mean, we were just it was a bifurcated market. We had some areas going up, some areas going down, but overall market it's like pulling teeth. to get the market to pull back at all. We saw a little bit of that selling, especially again on the NASDAQ, which is the area. If I was bearish, I would really be concentrating on that because that's a group that's been moving higher. It's a group that's been leading the market to the upside. And it's actually one of the few areas right now which is struggling a little bit, trying to get back up through those recent highs, but unable to do so far. Moving on to the sectors, energy continues its move to the upside. Another big day yesterday on energy, rising up over 90 and moving back up to threaten some of the highs that we saw last fall. So we'll see whether or not that continues. Materials going right up with it. So energy and materials, two of the strongest areas in the market right now. I think, when I look at those further out, I think you've got to be aware of what's going on with the dollar. Because when the dollar is rising, which it's been doing primarily since about 2011, that puts kind of a lid on both materials and energy on a relative basis. When the dollar is weakening, that can really just blow the lid off the top on both the XLE and the XLB. That's when we tend to see extremely solid relative performance there. So we've been seeing the solid relative performance in the group, but the dollar longer term still looks like it's in an uptrend to me. And I'm expecting it to continue to go higher. Maybe I'm wrong. If you're an energy bull or a materials bull, you need to hope I'm wrong, because that's going to be the better environment for those stocks is with the dollar falling. Financials also continuing to move higher. I mean, this has just been a steady push to the upside, almost zero volatility in this group. It just keeps wanting higher prices. I think the banks are going to be strong. I've talked about that many times already this year. I just see a future later this year with the short-term rates coming down. The 10-year Treasury yield may be coming down a little bit, but probably just meandering mostly sideways. And that environment will flip the inverted yield curve. And all of a sudden, banks, with the economy remaining resilient, banks have not really had to go too much into their loan loss reserves that most loans continue to be healthy. And as a result, that's one of the reasons why banks continue to lend and why we haven't seen any kind of recessionary type behavior, any slowing in our economy, because our banks remain able and willing to lend. Many times when you see that inverted yield curve, you'll see banks unhealthy, because a lot of times that will signal more weakness in the economy. And as a result, some of the loans start going bad. You start seeing loan loss reserves hiked on banks. And that combination of lower interest margins, net interest margins, and higher loan loss reserves are really bad for banks, and they stop lending, or they start to really pull back. Some of the questionable loans they won't make. That's the difference. Right now, we're not seeing that. And the banks are starting to strengthen. And with what we're seeing down the road in terms of the short-term interest rates coming down, that's the bank's borrowing rates. Any of the banks that use a lot of those either rely on deposits or rely on getting money through the Fed, those rates are coming down. So it's increasing that net interest margin for banks. And then throw in an economy that's strong. And if that continues to strengthen, and you would think it would with rates dropping later this year, that is nirvana for not just banks, but for financials in general. So that's one of the reasons why I'm really bullish on the financials. I think they go higher. I think the banks have a really good year, maybe a really good couple of years ahead of them. We'll see. But anyway, look at the chart. Chart doesn't lie. I can spout off anything I want to say, but look at the chart. XLF going straight up. I think that continues for quite some time. We'll have pullbacks along the way, of course, but I'm talking about the general trend. I expect financials to do very well in 2024. Non-ferrous materials leading on the in the industry group area. Of course, this index is based a lot on Freeport-McMoRan, and I'll just show you a really quick chart. Actually, let me go over here, and I'll just pull this up for you. If you see FCX, look at this move to the upside. Yesterday, gaining 7.5%. So when we go back and we look at the non-ferrous metals gaining 7.5%, now you know why. It's not a lot of stocks that go into this index. It's primarily Freeport-McMoRan, which is ticker symbol FCX. Then we got the exploration and production stocks leading energy to the upside. This group now gaining another 2.25% yesterday. Look at where we are. I mean, continuing to trend well above the 20, which is well above the 50. Only thing I always look at when I'm watching the energy and the materials group is sometimes the carpet just gets pulled right out from under your feet. At least that's been my experience over the years. So I really want the environment to be stronger for these groups to really believe in them longer term, that they can be outperformers. We need to see that dollar start to fall much more than what we've seen of late. And then finally, personal products. This has been one of the worst industry groups for a long, long time. It's got a couple of outliers like Costco, although I really don't believe Costco belongs in this index. I think Costco is more of a Walmart type or something like that. But anyway, personal products, look at the double top. Just broke out. Big move yesterday, gaining more than 2%. So now we got personal products leading to the upside. What a lot of this is telling us is, where's the weakness in the market? Find weakness. I mean, it's like find Waldo. Where's the weakness in the market? I mean, there's still people out there that are just totally bearish this market going forward. And I'm not talking about short-term cautious. I'm talking about full-on bearish. I don't get it. I don't know how you can look at this market and look at where the sentiment is, where the 1 year moving average of the equity only put call ratio is, which has been extremely high, starting to roll over. This is times when the market goes higher. It's why I will not give up on my bull market thesis long term. Short term, yeah, I've been pretty cautious probably for the last 30 days. I mean, the market hasn't gone up a lot, but it's continued to try and, push higher and higher. And it's like I say, it's so difficult to bet against a secular bull market. Anybody who's long term should just stay on the long side until, at a minimum, you've got to get some confirmation of price action to the downside. I mean, you don't go from bull market to bear market in a day. It's going to take some deterioration in the indices. It's going to take some, at least the start of some pain to get the wheels rolling. I mean, we really haven't seen much of that at all, including during a period when we typically do see more struggles. Market just doesn't care. So that's where we're at right now. 10-year Treasury yield. So let's get that update. Right now, 4.24. So it's gone up another 2 basis points since the start of the show. So we're definitely seeing the yields moving to the upside. And I mentioned yesterday, I don't know if it was on the show or to members because we did a live trading room yesterday, but I said if there's one thing maybe that could spook this market in the near term, it would be the 10-year Treasury yield. Everybody's expecting rates are going to drop. Fed keeps talking about the short-term rates dropping. Of course, that doesn't impact directly the 10-year Treasury yield because that's more long-term. Think of 10-year Treasury yield like mortgage rates. That's kind of the barometer for mortgage rates. But right now, this 10-year Treasury yield also being somewhat resilient, not really wanting to roll back over, staying up. Ultimately, long term, I think this is great for banks, though. If the 10-year Treasury yield can stay up around 4%, between 3.5%, 4.5%, we can kind of sit in that range for a while the short-term rates keep coming down. Net interest margins on banks go up. And so I believe that's what's being factored into the stock market right now. The financials are going to see their earnings expand down the road. Think about how fast the QQQ went up before we started seeing all these crazy beats in the semi space. A lot of it was built in. The market starts anticipating. That's what we're seeing in the financials right now, in my opinion. All right, S&P 500. Oh, and by the way, there were some other economic reports out. I've mentioned the inflation at the top of the show, but we also had retail sales, which came in slightly below expectations, which I think is good for the market because you don't want inflation reports going up and see economic reports that could suggest overheating of the economy. So the expectation for retail sales was a gain of 0.7%. For the month of February, it came in 0.6%, slightly below expectation. If we strip out autos or vehicles, we were expected to come in with a rise of 0.4%. It was only 0.3%. So again, that is helping a little bit offset what we're seeing in the inflation numbers, the PPI numbers this morning. Next up, there was, of course, initial jobless claims, and initial jobless claims were expected to jump. Last week was 217,000. Those were revised down to 210, but we were expected to come in at 215. So we were expected to be higher than what was, than our revised number. And instead of 215, we actually came in at 209, so last week's initial jobless claims number was revised lower. And then we came in below expectations again. So the economy remains very strong, not apparently too strong based on retail sales, but the market is dealing with an economy that seems still very resilient, maybe not lights out hot, but with rates expected to come down and inflation continuing to come down, even though the last couple of reports we've had, a little hiccup, that combination is so bullish for equities. And I think that's why we're seeing a lot of bad news just being ignored. I think the market is focusing on what it sees down the road, and it's not so concerned about a short-term blip in inflation. That's my only explanation. I mean, if you have others, feel free to type it in, into the chat box. But yeah, I just see a market that's resilient, just doesn't want to go down. But I'm going to watch the 10-year Treasury yield because I do think if there's one thing that could spook the market, it would be rates breaking back out, yields breaking back out above that 430, 435 area. And getting back above the 20-day and getting back above 420 is at least a start. So if the yield keeps going up today, I'm going to update it again just to see. Now it's kind of just ticked back just a little bit over the last couple minutes. But if this keeps going up, at some point you wonder if it'll take a toll on stocks. So that's one thing I'll be watching intraday today. Higher inflation report than expected, which is resulting in what I would have expected, yields moving up a little. But if that continues, does it have an impact during the day on stocks? Can't answer that yet, but I'll be watching it throughout the trading session. S&P 500. So again, we're just kind of meandering higher. Yes, yesterday we were down a little bit, but that was after we made a 52-week high and an all-time high or at least all-time high close on the S&P 500. If you're somebody who follows the intraday, then you will want to follow last Friday's intraday high on the S&P, which was 5189.26. So yesterday closed at 5165. So go up a 0.5%. That basically is going to take us up to 5190. So if the S&P rises more than a 0.5% today, and I mean, we can come over here and just check and see where it is right now. The spider up 0.2%. If that were to climb, get up over 0.5%, we're going to be right back to the all-time high, even on an intraday basis. Of course, it still comes down to the QQQ. QQQ up about 0.2%. So we're kind of coming back down again on the QQQ a little bit. And if we pull up this chart, you can see we still got some room to the upside. We got to get through 448. 448.64 is the high. And the high candle body is, let's see, it's 445.81. Yeah, 445.81 if you're looking at the QQQ. So we're $5 away, more than 1% away on the QQQ. And again, that just kind of shows you a little bit more of the rotation away from the NASDAQ, just kind of subtle. But you see the NASDAQ's down a little over 1% from its intraday high last Friday. The S&P's down about 0.5%. So we're seeing a little bit of that rotation away from the NASDAQ and into more value-oriented stocks. And all of a sudden, nobody's talking about breadth anymore. Breadth isn't a problem. Wow. That's what I said a long time ago. Don't pay any attention to the breadth when everything else follows suit, especially when you start seeing small caps and the mid caps starting to do well. That's when you are going to see the breadth pick up because you got a lot of those small and mid-sized stocks. And when they start moving, that's when you start to see breadth, and along with all the defensive and value-oriented areas that are breaking out. It's not like technology is breaking down. It's just consolidating. We're seeing a little bit of rotation, a little profit taking, and that money is finding a new home. It's not leaving the market. That's the key. Bull markets are, I mean, the hallmark of bull markets is rotation, wide participation. That's what we're seeing. We're seeing that shift. Now, some arguably, and I wouldn't blame them, might say, well, what about your sustainability ratios, Tom? You kept talking about those being great when we were at a market bottom and strengthening, and then throughout the bull market kind of going along. How come they don't give you a bearish signal now? Because they're not necessarily participating. Number one, sustainability ratios are a secondary indicator, and it's just one indicator. When we talked about a market top in 2021, at the end of 2021, we had not only those sustainability ratios that were faltering, we had the most unbelievably complacent readings on the equity only put call ratio. I mean, the equity only put call ratio almost every day was below 0.50, where in history, we had few days that went down below 0.50 or 0.45. And that was the average at the end of 2021. I mean, so we had sentiment skewed so far to the bullish side, there was no more money to come in. And we were seeing sustainability ratios weakening. And we were seeing negative divergences, not on the daily charts, on the weekly charts. You want to look at the QQQ weekly right now? I mean, boom, it's been going straight up. How about on a monthly? I mean, go out all the way to the monthly chart. We reset 50-month moving average test, PPO centerline test. What are we doing since then? I mean, I'm seeing momentum building, continuing to build. And again, if you're saying, well, no, you got negative divergence, I would just point you back to the last 10 years. How about the monthly high here back in 2015 when we broke out, here, negative divergence. We broke out all of this, negative divergence. I mean, I don't think we broke out above that. We did not break out above that top over here in 2014 until we got to 2020 after the pandemic. So you would have missed, it was in July that we broke out of 2020. So from here to July of 2020 to here, let's see, what was that? We were at roughly 100 on the QQQ. And in July, we were at almost 300. That entire move up was with the PPO lower. Divergences are not our primary indicator. They're a secondary indicator. And when you see price action moving up and you go through periods where it just goes up every single day of not every single day, but most days, most weeks, through an entire year or two, how can you argue there's slowing momentum? Doesn't make sense. It doesn't make sense to go back so far, and especially after you've had a centerline test, because right there, that's the definition of no momentum at all. You've reset the momentum here. Now, as we're going higher and breaking out to all-time highs, I'm seeing momentum accelerate to the upside. How can I be bearish? So yes, sustainability ratios have weakened. I admit it. And that's why I say, hey, short term, I think we could have a pullback, because that is one signal that tells me, even though I think long term it's bullish because we're getting wide participation, I think in the short term, it's telling us that we're seeing money rotate away from some of the areas that have been leading the market. Technology, we've seen a little bit pull away from semiconductors. That's what's been leading. So it kind of makes sense that if those stocks pull back, maybe we'll see a little bit of consolidation or some selling in the market in the near term. It hasn't happened because there are so many interested buyers in other areas of the market that were beaten down. They didn't go along for the ride. Many of these consumer staple stocks basically just kind of flat over the last few years. I think that's changing, and I think it's changing in a bullish way. Anyway, let's keep moving on here. NDX, kind of same thing, negative divergence. IWM, and again, the negative divergence in the daily, on the daily, not the weekly, not the monthly. IWM pulling back, but staying above the 20-day, rising yesterday. Looks like it reversed off this downtrend. I think it needs to hold yesterday's low around 204.77. So let's see what we got here. Well, down 0.3%. We'll see if it holds. In the overall market, again, remember Max Payne this week. We're seeing QQQ coming back down a little bit. I don't know. Short term, again, I think you can flip a coin. There are a lot of signals saying we should pull back a little bit here. Not a lot, but even just 2, 3, 4%, just something. So you've got that on the one side, and you've got this massive secular bull market on the other side that just doesn't want to hear any of it. And unfortunately, in the short term, that's what we're facing. Again, long term, I love the market. And I can't be clear because I've had members ask me, you talk about the market being bullish and then you say the market's bearish. I don't get it. Bullish long term, cautious near term. Big difference. It's, kind of having that forecast. If the market pulls back, I'll be buying it because I believe we're going higher in the long term. That's a big difference in how we look at that. Anyway, transport's trying to break out of the recent range, couldn't do it. Came back down, closed on the low yesterday. It's just range bound. Look at the PPO. It has just been sitting on the zero line for a month. Just almost zero volatility. Waiting for something here. I do believe this is a bullish pattern now. Uptrend followed by consolidation. So I expect eventually we break out here. I like the transports. I think some of the areas like the railroads, which didn't perform well for quite a while, I expect areas like that to do very well later in 2024. All right, chart of the day. So first of all, go over to earningsbeats.com. If you haven't already, please sign up. A free 30-day trial. You have to give a credit card, but you get everything that we have to offer. 30 days for free. Check it out. Then scroll down if you just want to learn a little bit more about us. Go to our Earnings Beats Digest. You can subscribe right on our homepage. One sec. Right here, middle of our homepage, just scroll down. Every Monday, Wednesday, and Friday, a free article talking about a chart that comes out. And of course, on the shows here, Tuesday and Thursday, I try to give you a chart of the day as well. But these are things that we believe in at Earnings Beats. If you enjoy, the way I approach the market, the calls I've made over the years, you probably should be a subscriber. I go over a lot of things that are important to us. Including relative strength, including gaps, earnings. My background as a CPA, we have a little bit of a unique business. Most businesses you see are either fundamentally driven or technically driven. We're both. Having, been in public accounting for 20 years, fundamentals are still pretty near and dear to my heart. But if you're looking to buy and sell stocks, you got to know the technicals. You can't just look at an earnings report and say, oh, well, the current ratio is strong. That means I should buy the stock. Doesn't work that way. You got to be really careful. You got to be technically savvy and also have that base fundamental understanding as well. But check us out using our EB Digest. We'd love to have you. So chart of the day today. So right at the end of the day yesterday, I went in and I looked through our short squeeze chart list, and our 13th stock I got to was SMR. And I ended up buying it. I have a market order to sell it this morning, but I bought it at the end of the day. It's crazy overbought, but that's what you want from a short squeeze stock. So first, let me just see, because we are opening in less than a minute. It's up almost 10% today, overnight. So what I want to do is talk a little bit more about short squeezes. And are we going to see more and more of these short squeezes take off or set up? Couple things about the chart. You'll see they're different. This chart looks different than many of the charts that I have, used in the past. Volume's at the top. Why would I put volume at the top? Well, if you're looking at a short squeeze, First thing you better make sure is that the volume is accelerating way above its moving average. Now, I have a moving average on here of the last 50 days. When you get a short squeeze, when you break out and shorts start panicking, volume should go through the roof. And if you're getting the move to the upside and the volume is staying down or below, at or below the moving average, I don't even pay attention to it. It's not a short squeeze. Where's the panic? If there's no volume, where's the panic? The other thing you need to have with a short squeeze is an uptrend. I don't buy short squeezes on pullbacks. I buy just about everything else in the market that I like on a pullback. I like to buy pullbacks, not with this chart list. Short squeeze chart list, I only want to own it if I feel like shorts are panicking and we're going up. And if we're going back down, shorts aren't panicking. You go back down. Some people say, well, I saw a breakout on a short squeeze stock and it pulled back to the 20 days. So I jumped in. I'm like, I wouldn't be trading it like that personally. I mean, maybe you'll see that from time to time, but this is really what I want. I want a parabolic move because many times you're going to see big gap ups. And that's why, and I just took a small position at the close yesterday. Be very careful. These are incredibly risky. They're not for everyone. You've got to be willing. This thing could have been down 10% at the open just as well as being up 10%. So I would just say you need to be really careful. But I'm going to go through, I want to show you a couple charts really quickly, or one chart very quickly, which is Tesla, which broke down again yesterday. This is one of those stocks that is not helping the QQQ or the spider. This is one of the key components, probably top 5, 6, 7 holding in each. But it's one of those stocks that's been holding the market back. And this stock has been holding consumer discretionary back because it's probably 20, 25% of the XLY. So there are some other impacts. It's not just Tesla. Tesla, if it's in an ETF that you own and it's a high percentage of an ETF you own, that's going to be an ETF that's very challenged right now because of that. All right, so what I would do with the short squeeze list, so we keep a short squeeze chart list. If you sign up for a 30-day free trial, you can come in and look at all of our chart lists. And if you're a Stock Charts Extra or Pro member, you can download every one of these chart lists. These are all the stocks on the short squeeze chart list. There are 50 of them. Literally, you can take this chart list, download it into your Stock Charts account in 2 seconds, 3 seconds. All the work we do, we put together, you can just own it. Just take it, put it into your Stock Charts account, start trading off of it, run scans against it. All that work that we do, all the research, everything downloaded. You can download all of our chart lists probably within a minute or two. I mean, even if you're slow and maybe 5 minutes, doesn't take long. All of our work, thousands of hours of research and education, all put into these chart lists for you. So Novavax, look at this move to the upside. See how it's gapping up every day and just keeps rising during that volume period? Like I said, sometimes you're going to, I don't know what the news was. Maybe they came out with some kind of a secondary offering because that happens sometimes. But, in an effort, some of these companies that are not doing very well, they want to raise money. And a lot of times they wait for a big move in the price to the upside to announce it so that they can then raise their money at a higher price. If they announced it down here, it's dilution. So they would have seen a drop from $4. Here, they're seeing a drop from $6, but it's giving them the money they need. Now, again, I'm assuming that's what happened here. I don't know that for a fact. But anyway, here's one. It's bouncing from the 20-day. I would feel better about it on a breakout above $6. This is going to make me nervous. I mean, you could take a shot if you want. I just think it creates a lot more risk. And we could go right down the list. Number 2, Beyond. Again, this one trying to bounce off of its 20-day moving average. It gapped up, but it looks to me like just more sellers came in. I mean, there's no real buying. I don't see too many hollow candles on heavy volume. So yesterday it went up a little bit. Volume was average. I mean, we need to see this thing break back out. I'll tell you, breakout above 11 or 12, I think stock could go up to 19. It could happen very quickly. So yeah, I'll watch it for that breakout, but I'm not interested in buying it on a pullback. IBRX. I mean, just first of all, just look at the volume. I look at that volume right here. No short squeeze. I just keep moving. Nope. And all I'm doing is looking at the volume. It's a little heavier than normal. Look at the trend going down. Do you see shorts panicking? It's not just about volume. You got to have prices going up too. Are shorts panicking? I don't think so. They're just making money hand over fist. And that's what most of the stocks on this chart list, that's what they do. They tend to go down. So it's probably only going to be a handful that, from time to time that you're even considering. Carvana, there was a big break. Volume's been so-so. I don't know. This one just not really showing a lot of short squeeze potential. So I'd have to, if I owned it, I'd own it because of other reasons, not because of short squeeze. Nope, volume not good enough. AI had a chance right here. And it looks to me like shorts just got control. Look at this coming down, hitting the 20-day. Now we're under the 20-day. Now testing this gap support. Will that hold? If it doesn't, we could see this thing right back down at 24 over the next couple weeks. Blink. This one kind of is starting to look interesting only because if it breaks above about 355, anyone who has shorted it in the last 3 months is going to be underwater. So that could lead to a little bit more buying. The big level on this chart, I think, is 450. If you get through 450, it could be a rapid trip up to 7. And we're talking about more than 50%. That could happen in a day or two. So just kind of watching these. Plug, nope. Trading down, volume not great. Zixi going up. Do you see any massive increase in volume? It's not a short squeeze. PCT, not really. And then here is SMR. And like I said, I had market order in to sell at the open. I might go back in and, oh, no, I'm not. This one, I think, reports earnings tonight. I think that's why. That's another reason I wanted to get out the open. So it opened at 770 and now is at 690. With earnings, who knows? If it comes out with better than expected earnings, this thing could absolutely explode. But why has everybody been shorting the stock? It's the 13th highest shorted stock. 29% of its float is short, 29.05%. And we put that in the name of all these stocks so our members know. They're all in order of short percentage of float. So the ones that I talked about first are the ones that have the biggest. That's why with Novavax, we get through 6. I could see the volume. You can see what happens. There's a lot of shorts in this. So you're going to see a lot of volume if we can get through $6. Anyway, that's all I have for today. I just wanted to go through that. Let me see where the market is, see if we're hanging on to gains. It's doing okay here. We got the Dow Jones up and the S&P both up around 0.2%. NASDAQ up almost double that. So we got that up around 0.36%. We've got small caps down, mid caps down, barely down. Mid caps are really been, that group has been outperforming MDY versus the IWM. Well, lately, not so much for last year. But here over the course of February and March, definitely we're seeing more strength. And this looks a lot less noisy if I put it on a line chart. But you can see how mid caps are doing relative to the small caps. So that's an argument. Maybe the mid caps are the better investment for now, based on what's happening here in the breakout versus the IWM. Either way, I like both of them. And then let's see the VIX. VIX down a little bit more, 13.60. I've done studies. I've actually written about it. You can probably go back and find one of my articles where I talk about the VIX. I think it might have been back in November of 2023 that I wrote that article in my Trading Places blog. But there's an article in there talking about the VIX and the fact that when you're below 20 on the VIX, the stock market has a tendency to go higher. When you're down, or when the VIX is below 17, you have even more powerful moves to the upside. And when the VIX is below 13, it's off the charts strength in the market. So, we're down close to that level where the market does very well. I know a lot of folks look at the VIX low and think, oh, that means the VIX has to go up and that prices have to come down. The VIX can go up with prices going up as well, as long as the VIX is relatively low. It's not until that fear gets up above that 20 level that you really have to be careful. If all of a sudden the market's breaking down and we see a VIX over 20, I'll be in cash. I don't take any chances with the VIX at that level. We're nowhere near it. 1360. Very, very calm market. And that's why we're getting this kind of boring action movement to the upside, just slow and steady, just burning shorts one by one. I mean, I hate to be harsh, but it's just the reality. That's what we've been seeing. All right, so let's go ahead and wrap up. Appreciate everybody tuning in today. I'll be back on Tuesday for your next Trading Places Live. Be sure to sign up for our 30-day free trial. Check us out for 30 days. At least become a member of our Earnings Beats community. We've got some breaking news. We just announced the members yesterday. Probably wait until Tuesday to announce it to the public. But a lot of good stuff going on in April that I think you'll all be excited about. So we'll talk about that beginning of next week. Also, if you really like the video, you like our style, hit that like button, please. It'll help us. And also subscribe to the channel. Those things do impact our algorithm on YouTube and can help build our community. So even if for whatever reason you're not helping us with membership, I get it. It's not for everybody, but you can still help us with that like and subscribe button. So anyway, everybody have a great rest of your week. Be careful out there, but also you got to keep one eye on this secular bull market because it just does not want to give up. Have a great weekend, everybody. Happy trading.